How pension funds became the bank's emergency piggy banks. The hidden truth behind pension funds. Pension funds are commonly seen as safe places where money sits until retirement. However, in recent years, these funds have become more active and risky. They're not just waiting to pay retirees, but are now involved in complex financial agreements called synthetic risk transfers, SRTs. These agreements allow banks to offload risky loans to pension funds in exchange for higher returns, effectively turning pension funds into emergency financial resources for banks. The risky business of SRTs. Banks create SRTs to avoid holding onto risky loans. They pay pension fund a fee to take on the risk of defaults. While this gives banks a chance to increase profits and claim lower risk, it shifts the danger onto the retirement savings of workers. This is a serious issue because if the economy falters and defaults occur, the pension funds will be the first to lose money. The impact of past financial crises. History shows what happens when pension funds take on too much risk. For example, in the UK in 2022, pension funds faced major crises because of risky investment strategies leading to massive bailouts. These scenarios illustrate how pension funds can be vulnerable if they invest in high-risk products while needing to pay out regular benefits to retirees. The pressure to produce returns. Pension funds are under constant pressure to achieve average annual returns of about 7.5%. This pressure makes fund managers desperate to chase higher yields in riskier markets, particularly since traditional safe investments now provide low returns. This desperate chase leads to risky investments that can endanger their ability to meet future obligations. The unseen consequences for everyone. If a large pension fund fails, the consequences extend beyond just the fund. It can lead to higher taxes or reduced public services since the government often steps in to bail out failing pension systems. Additionally, when pensions invest in risk-laden assets, it creates a cycle that can destabilize the economy as funds sell solid investments to cover losses in bad times. Understanding how pension funds are being used as bank safety nets is crucial. These funds are intended to provide stability for retirees, but the current financial practices put that purpose at serious risk. Everyone should be aware of these issues, as they can impact public services and economic stability on a larger scale.